So we're going to look at the 2010 FRQ right now. It says, assume that the United States economy is currently in long-run equilibrium. All right, so if we're at equilibrium and we want to do this, draw an ADAS graph, so it's just going to be the intersection of AD and AS is going to intersect along the vertical LRAS. And then part B says, assume that the government increases spending. Oh, okay, whenever there's an increase in spending, that means demand moves. So demand and spending are directly related. So if there's an increase in spending, that's going to be a rightward shift of that aggregate demand line. So we can go ahead and show that, that rightward shift on the aggregate demand line. And how will this government action affect the unemployment rate in the short run? Explain. Okay, so if aggregate demand is increasing, that means that there's going to be an increase in real GDP. So we're making more goods and services. If we're making more goods and services, that means we need more workers. So unemployment goes down. There's an inverse relationship between GDP and unemployment. So let's go take a look at a scoring guideline here. So AD1 and short-run aggregate supply 1 is where we started off. That's the equilibrium positioning here. So you could have a YF if you wanted to. Actually, I think they told you to put, yeah, it said YE, sorry. They said YE and PLE. So you got to do that, YE, PLE. So that's our equilibrium positioning here. And then for part B, we're going to increase aggregate demand out here, increase of government spending. And now let's take a look at C. So assume that the economy adjusts to a new long-run equilibrium after the increase in government spending. So this is now we're in the inflation. What's going to happen in the long run? So in the long run, we always come back to equilibrium. Always come back to equilibrium in the long run. So we're in inflation. Notice how aggregate demand and aggregate supply are intersecting beyond the LRAS. So we're currently producing beyond our potential output. So we're in inflation. In the long run, we have to come back to equilibrium. So what's going to happen here? In inflation, wages are higher. You have a really low unemployment rate. We have really high wages. In inflation, prices are up, so workers demand an increase in their wages. As workers demand increase in their wages because of this inflation, because higher prices, that means the cost of production is going to go up. Aggregate supply is inversely related to the cost of production. So as workers' wages go up, that means the cost of production goes up, and as cost of production goes up, aggregate supply will decrease and shift to the left. Remember, this is a leftward shift. This is a decrease. I know that visually it looks like it's going vertical, and you know that looks like an up thing, but that's not the case. It's a leftward shift. This is a decrease in aggregate supply. So as cost production is high in inflation, aggregate supply decreases and shifts left. That's going to get us part C there. D. In order to finance the increase in government spending on national defense from part B, okay, so we increase spending, the government borrows funds from the public using correct level graph of the level funds market, show the effects of government borrowing on real interest rates. We know that whenever there's government spending, what's going to happen here, there's going to be an increase in demand. Remember, spending moves demand. It moves all the demand lines. It moves aggregate demand, demand of level funds, demand of money. And if there's spending in our economy by foreigners, it's going to move the demand of our dollar. If you can just remember, spending and demand are directly related, you're good to go. For the other supply lines, remember, aggregate supply is inversely related to cost of production. Supply of loanable funds is just that extra money. And then the money supply is monetary policy, straight from the flow chart. You're good to go. So whenever there's increase in spending, like government spending, demand goes up. This should seem logical that when you're demanding more of something, like you're demanding more loanable funds, it should cost more to get those loanable funds. And the cost of getting loanable funds is interest rates. If you get a loan, that's for real interest rates here. All right, moving on. Part E, given the change in the real interest rate in Part D, what is the impact on each of the following? Investment, economic growth rate, explain. Okay, So we know that straight from the flow chart, guys, as interest rate goes up, your I sub G, your investment, is going to go down. It's more expensive to borrow money. So we're going to buy and borrow less. We're going to buy less capital, less investment. And when you have less capital, less machinery, less tools to make anything, the economic growth rate is going to go down. You're going to see a reduction here or a decrease in the economic growth rate. There's going to be a slowdown. All right, number 2, a drop in credit card fees causes people to use credit cards more often for transactions and demand less money. Okay, they're telling you that they demand less money. Money demand going down. Using the correct label graph of the money market, show the nominal interest rate will be affected. All right, but they're telling you demand less money, so money demand goes down. If you're demanding less of something, it should cost less to get it. Cost of getting something, cost of getting money is interest, so interest rates should go down. Let's go ahead and graph this out, though. Simply have the vertical supply of money line here, or money supply line, the downward sloping, and it can be a straight line if you wanted it. Money demand or demand of money. Remember, money market graph is nominal interest rates, nominal MN, nominal interest rates. They're telling you that they're demanding less money. So money demand going down. If you're demanding less, it should cost less to get it. It's not in high demand, so interest rates drop. Given the interest rate change in part A, what will happen to the price of bonds in the short run? So bond prices are inversely related. Bond prices inversely related to interest rates. So as your interest rates go down, bond prices go up. Bond prices go up. Given the interest rate change in part A, what will happen to the price level in the short run? Explain. So if we're seeing that interest rates go down, what's going to happen is cheaper to borrow money. People are going to borrow more and spend more. This is straight from the flow chart again. So as interest rates go down, you're going to see people borrowing money and spending it on either consumer products, consumption spending, or I sub G, your investment in capital and business spending. Those are components of aggregate demand. C and I sub G are components of aggregate demand. So when interest rates go down, C and I sub G go up, causing AD to go up. And when AD goes up, that means that your price level is going to increase. Both price level and real GDP go up. D, identify an open market. Okay, so open market, buying or selling bonds. An open market operation the Federal Reserve could use to keep nominal interest rates constant at the level they existed before the drop in credit card fees. So the drop in credit card fees, we know, caused interest rates to go down. So now we need interest rates to go back up. How do we get interest rates to go up? Using either buying or selling of bonds to get interest rates to go up. All we're going to need to do is sell bonds. Selling bonds is going to be contractionary monetary policy. Again, straight from the flow chart. If you sell the bonds, the supply of money shrinks, interest rates go up. Let's take a look at number 3. A United States firm sells $10 million worth of goods to a firm in Argentina where the currency is the peso. Okay, so we're selling things to Argentina, and Argentina is buying our stuff. So in order for Argentina to buy our things, Argentina would have to supply their peso and then demand our dollar. By selling stuff to Argentina, this is good for the United States. We're exporting more. In Argentina, they're going to be importing, and that's not good for them. Imports are a leakage; it's a negative. So let's take a look here. How is it going to impact their aggregate demand? Because they have more of those leakages, more imports. Their ex-event is going down. Ex-event is a component of aggregate demand. So Argentina's aggregate demand will fall. Why? Because they've increased imports, or as I just stated, decrease their net exports. B, assume that the United States current account balance with Argentina is initially 0. How will the transaction above affect the United States current account balance? All right, so we just stated that the United States is exporting more. That's a good thing. Exports are positive. That's an injection. So we're going to see that the current account balance is going to move into a surplus. It's going to be more positive because we are selling those goods and services. The United States current account balance will be in surplus or increase because exports are those positive things. All right, let's take a look at C, using a correctly labeled graph of the foreign exchange market for the United States dollar. All right, so this is in terms of the dollar. Show how a decrease in the United States financial investment in Argentina affects each of the following. All right, so we are not investing in Argentina. We show a decrease in the United States financial investment in Argentina. So maybe we used to be buying their bonds and we're no longer buying their bonds. If we're not buying their bonds, that means we're not demanding the peso. If we're not demanding the peso, then there's no reason for us to supply our dollar. You know, we would supply our dollar to demand the peso to buy their financial products. But because we're not buying their financial investments, we're not demanding peso, so we're not supplying our dollar. So what would happen to the supply of dollar? It's going to decrease. There's no reason for us to supply it because we're not demanding the peso. And if the supply of something decreases, that means it becomes more rare. And if something becomes more rare, it should become more valuable. So in terms of foreign exchange, they would say the currency has appreciated. So the United States dollar will appreciate relative to the peso. Let's take a look here. So we have peso over dollar, dollar down at the bottom here, and then just the decrease in supply. You know, there's no reason for the United States to invest over there, so they're going to decrease the supply of dollars. Lastly, suppose that the inflation rate, okay, so this says inflation. It does not say interest. It says inflation. Suppose that the inflation rate is 3% in the United States and 5% in Argentina. Okay, so Argentina has more expensive stuff. It's, you know, price levels are high in Argentina. What will happen to the value of the peso relative to the United States dollar as a result of the difference in inflation prices? So if everything is more expensive in Argentina, what are the Argentinians going to do? The Argentinians are going to buy the cheaper stuff in the United States. And when they're going to buy the cheaper stuff in the United States, they're going to have to supply their peso, demand the dollar. So the dollar will appreciate and the peso will depreciate. The peso will depreciate. You know, we're not demanding the peso because no one's buying the inflated prices in Argentina. They're not buying their goods and services. All right, so that is it. That's 1, 2, and 3 for 2010. Hopefully you guys learned something there. All right.